And welcome to the induction task for economics A-level at Coopers. My name is Mr. Kemp. It's my pleasure today to take you through the induction lesson. Obviously, it's quite a weird time, so we're all having to do this online, and it would be much more convenient, much more natural, I think, for us to be meeting in person. But I hope you're all well, and I hope you're all able to tune in and to follow for the next hour or so what we're going to go through today. As I've said, my name is Kemp. I'm one of the economics teachers at Coopers, and we're just going to sort of very gently today give you some idea, some flavour of exactly what Coopers is economics is like at Coopers, rather, and some idea of what the demands and form of the economics A level actually are going to be. Okay, so first things first, we pursue the Edexcel specification A. Now, that's quite easy to find on the web in terms of, if you're looking to find out exactly what the specification is, all you have to do is Google economics or Edexcel economics. As I've said, our route is A, and you'll see the full A-level specification there. Exactly what you'll be studying rather over the next 2 years or so, and you'll have a chance to get, as I said, get to grips with exactly the sort of topics and areas we'll be talking about. I'll leave you at your discretion to pursue that. I thought I'd just introduce you to the major division within the subject, and that's this idea that we are divided effectively into two approaches. One, which is microeconomics. Now, microeconomics is the economics of the individual, be that the individual business, the individual consumer, the individual sector within the economy. So that's looking at things like supply and demand, elasticity, government intervention into markets, taxes, subsidies. Now, all of these things may not be familiar to you, but as I've said, over the course of the next 2 years or so, hopefully they'll become very clear and you'll get very familiar with exactly what's going on. The course, the specification is divided into 4 themes. Theme 1 and Theme 3 in years 12 and 13 respectively are the microeconomics themes, which, as I've just said, is really about economics of the individual. The macroeconomics, which is, incidentally, the bit that I spend most of my time doing. The macroeconomics is the economics of the whole economy. So whether that's, the UK, the European Union, the global economy, international trade, inflation, unemployment, economic growth, government debts, policies, all those sorts of things are the macroeconomics. So the economics of the whole economy, those are themes 2 and 4 in 12 and 13. And again, you'll become familiar with exactly the language and the terminology that you'll be immersed in over the next couple of years. As it suggests on this slide, the qualification is broken into 3 papers. One for the micro, which covers themes 1 and 3. One for the macro, which covers themes 2 and 4. There's a third paper, which is the synoptic paper, and that's basically a mashup, if you like, of micro and macro aspects. So it basically looks at economic problems in the round, both from a micro and a macro dimension. Hopefully that's relatively clear. Okay, so if I could move on, and you can tell I'm not very good at this, to the next slide. What is economics? What do we mean by economics? Well, what we're going to look at today is exactly what the economy is, what economics means. It's not an easy thing to define, I suspect. It's not the sort of thing that we all have a very clear handle on in terms of definition and how we can pithily sum it up. Probably the best way of doing that is to maybe look at how an economy works. And the first thing we're going to talk about here is something called a circular flow model. And I say the first, that's basically all we're going to discuss over the next 50 minutes or so. Now, a circular flow model is a model of the whole economy. So it's a macro idea. It looks at the economy in terms of sectors. Now, you can divide an economy up into lots of different sectors. Public sector, private sector is one way to look at it, agricultural sector, housing market, etc., etc. But the circular flow model really looks at the most basic types of sector. And as it suggests here, there are two, one of which is the household or the consumer sector, and the other which is the business or the producer sector of the economy. So the circular flow model looks at the economy in those very simplistic terms. Now, if we just go on ahead here, you can see that what we've produced is, or what I produced here, is a simple sort of little a diagrammatic representation of those two groups. Consumers on the one hand, households if you like, and on the other we're looking at producers. So we've got a sort of icon which represents a household, one which represents a factory, a shorthand for those two sectors. Now the idea is that there's a sort of schizophrenic element to this, if you forgive the clumsy sort of analogy. We are, once consumers, because we all go out and spend money on a regular basis in shops and restaurants, wherever it happens to be, as consumers. And on the other hand, we also work for businesses and act as producers for those businesses when we provide them with our work, our labour, our efforts. So when we look at the economy, you can divide it into those two very simple, very specific, very straightforward sectors. Consumers, on the one hand, us acting in our own interests to buy and purchase goods and services, and on the other hand, producers, whose rationale, raison d'etre, is to produce goods and services for us to purchase from them. So really straightforward, nothing too difficult there. Now, if I move things on a slide, the diagram starts to sort of develop a sort of logic, I suppose. These two arrows you can see on the diagram that we've produced so far. The first, the innermost, represents the households providing labour to the producers, the factories at the bottom. So there's a couple of logical and important points to make here. This diagram and the producers in the diagram represent the domestic producers within the economy. Now, by domestic producers, I mean that those producers who are based within the economy that we're examining. So they are the producers who provide jobs for the labour force within that particular economy. They're based in that economy, so the labour force works for those businesses. So you can see here that labour is provided by the households to the producers. Now we give that a shorthand, so we simply sort of start to introduce a simple, really very simple bit of algebra and use the letter L to represent that labour that is provided by the households to the producers. On the other hand, of course, in return, the producers give us wages because we don't work for nothing for obvious reasons. That's what we sell to producers, our labour, our time, and in return we get wages, which in this case I'm going to simply use the shorthand income. That covers wages, salaries, any stipend, and we're going to use the notation Y for income. So that's the start, the very straightforward approach that we take in the beginning. I think we can all appreciate that we work and we receive income in return. Now, to complicate things only a little bit, with the money that we earn, we spend. Now, spending, purchasing goods and services, is termed consumer expenditure in economics. Now, consumer expenditure is spending on consumer goods, the goods that we want in our house. So whether that's, washing machines, cars, groceries, software, anything that we use for our own consumption is made up or rather C is made up of that sort of those purchases. So that's consumer expenditure, C, in our notation. And of course, the money that we spend in return buys us those goods and services that we term the output of the business. In this case, the notation is O. So that is a very, very simple model of the economy, a very simple circular flow diagram, which represents the way in which an economy works. We give labour to the businesses give us income in return, we spend that income, and we receive the goods and services, the output of those businesses, as a consequence of those expenditures. So really simple, a really simple way of looking at the economy, and a really simple way of understanding what economics is and means in the first instance. Now, you can tell from that particular model, we can make a couple of obvious, or we are making a couple of very obvious assumptions. First of all, and most significantly, we're assuming that what we earn, our income, we're spending. So income is made up of consumption expenditure. In other words, Y, income is the same as C, consumer expenditures. So that's our first assumption. And you can see that that's what the model suggests if you go back a slide. And you can tell that that's the basic assumption, the basic point of departure in the model. But of course, that isn't true. We do not spend all of our money, all of our earnings. And the first and most obvious point is that some of that income is saved. Now, in economics, it's consumers who save, and that's probably a reasonable assumption. They're the ones who actually save money, put money to one side. We sometimes call that excess income in economics. Now, those savings are obviously lodged, given to a bank. So on this little pictogram, you can see that consumers are saving with banks. Now, that's a flow away from consumers. That's money that consumers put aside from their earnings. Now, that means that we have now introduced another sector to our model. So we started off with simply consumers and producers, but now we've had to add a banking, or if you like, a financial sector to our economy. We don't just consume, we save as well. So income is not just equal to consumption. Now it is equal to consumption plus savings, or in notation, Y is equal to C plus S. Nice and straightforward, I hope. Now, the important point here is that is as follows. Savings are actually a leakage from the flow. If you went back to the diagram that we constructed initially, that very simple circular flow model, you can see that money circulates around the economy. We provide labour, we get paid. Those payments are then returned to the producers in terms of consumer expenditure, and in return, in due course, we receive the value of the output of those businesses. Now, that, if you like, is water sloshing around the economy. The money there you can think of as a metaphor, or water is a metaphor for the money that sloshes around the economy. Now, if we don't spend all of the money that we earn, which we don't, I hope you'll agree, then savings have to be taken out of that flow. They leak away from it. Now, obviously, you cannot have leakages from a closed system without the system bleeding dry eventually. So they have to be balanced by an injection. Those savings have to be balanced by an injection into the economy. Now, in this case, again, bear in mind that we're looking at banks. Banks now provide investment. Now, investment is, if you like, an injection into the flow. That's what balances out our leakage. Now, the important thing to note here is that we save money into banks. So we put money aside, excess income, into banks. The banks recycle those savings. They lend them, they invest them, normally, not exclusively, of course, and this is a bit simplistic, but normally with producers. They invest They put money into the capital, the productive potential of businesses, where the returns, of course, are most significant, are highest. So this pictogram simply shows money coming back from the banks into the producers. In this case, back into the circular flow. So what we've got is we've got leakage, we've got that money that comes out in terms of savings being balanced with a flow back into the system from the banks, which we term investment. And you can see that that is given the notation I in our algebra. Nice and straightforward, nothing too different. So have we now got a better model? Having started with a really simple idea, this idea of a circular flow, have we now got something which is substantially better? Now, as you can see, as I suggested to you a moment ago, why income is now made up of consumption and savings. Or to look at it another way, Y is equal to consumption plus investment, C plus I. Now, that's simply because the savings that we leak out of our flow are balanced by those injections. So we're assuming that S is the same as I, so those two formulas, the substitution is relatively straightforward. So with our income, we consume or save. But is that fair? Is it realistic to say that all of the money we earn is consumed or saved? Hopefully, already you're saying, no, of course it isn't. Now, this is the best I could possibly do for a icon that represents government. And you can see that what I'm suggesting here is that consumers don't just consume, spend their money on goods and services. They also save and pay taxes. So, excuse me, you can see that if you are a consumer, if you're earning money, excuse me again, you have to pay taxes. So my money, my income from the school is deducted at source, or taxes are deducted at source. I'd never get to see all of my gross income. It's always post-tax. Those taxes are taken away. I can't avoid them. Direct taxation. And those taxes are paid effectively to the government. Now, once again, this is a leakage from our system. It's money that isn't returned to the producers for goods and services. Instead, it leaks out in the form of taxes. And therefore, as a result, it is another leakage from our circular flow, but it's also another use of our income. And that's important to bear in mind. So we've now introduced another sector. So no longer do we simply have consumers and producers and the banking or the financial sector, if you like. We've now got a government sector. Now, the government are the ones who receive the taxes that we pay from our income. So therefore, as a result, we can simply say that income isn't just about consumption and saving. We also have to add taxes into the mix. So Y is equal to C plus S plus T. But as I suggested, taxation is also a leakage, and it can't be removed from the system for the system to be successful without something to balance it out, an injection. So if taxes are leakages from the system, they have to be balanced by an injection into the system. And of course, in this case, the injection comes in the form of government spending. Now, the money that we pay in taxes funds education, funds the National Health Service, funds nationalised industries, the public sector in general. Now, the money that the government take from taxes is therefore used to provide largely public services, but not just public services. They're also used to provide what we call merit goods. So things like street lighting, defence, etc., which you could, I suppose, determine or define as a public service as well. So the government uses that money to provide services, output that we consume as households. So that's an injection back into the system. The money that we're taxed is pushed back in terms of the provision of health, education, social services, pensions, etc., etc. So that's an injection to the system. That balances out that tax leakage that we discussed. So a better model still? Question mark. Well, now we're saying that with our money, we can consume, save, or pay taxes, or if you like, we can consume, invest, or receive government expenditure, since we are assuming that S is the same as I and T is the same as G. Taxes are the same as spending. And therefore, as a result, we might have a much more complete picture of what we do with our money. But as the slide suggests, do we just save, pay taxes, or consume with our income? Isn't there something else that we do? Now, this is a little bit more tricky and a little bit harder, I suspect, for some of you to surmise, to guess what else we might do with our income. But I suppose the obvious approach is to look at the machine that you're viewing this on. In my case, it says Asus. The phone that's just to my left-hand side is a Samsung. As I look around my house, there's a TV, again made by Samsung. There's a printer just to my right, which is made by Canon. Now, all of those goods are produced by businesses, enterprises, which are not based within the UK. Now, that means that the money that we spend doesn't stay within our economy. If you think back to the simple diagram that we produced at the beginning, you saw that the money that we were paid by our domestic producers was given back to them in the form of consumer expenditure. Here, that money is not given back to the businesses, the producers who provide us with jobs. The money goes outside of our economy. And therefore, as a result, what we're actually talking about is what we term import expenditures. So with the money that we earn, we don't just spend on consumer domestically produced goods and services. We buy a lot of goods, whether it's our iPhones, our iPads, our cars, our washing machines, from overseas producers. Now, those come into our economy from outside, but the money goes out. The revenue, the expenditures leave our economy. So they are leakages again. And therefore, as a result, we have import expenditures being a leakage from our circular flow. Money, again, that doesn't go back to our domestic producers, but rather leaves our economy. And a lot of our expenditures do go overseas. If you think about how many goods we buy that are actually made and produced in the UK, if you look around your house, you'll be staggered by how few there actually are. That means we've added yet another sector to our model. Now we are talking about an international trade sector. And that reflects the fact that we buy goods, as it says, from producers overseas. So our formula now looks with an international trade sector, the ability to buy goods from overseas. Our equation, if you like, now looks slightly different. Income is made up of consumer expenditure, purchases of goods and services from domestic producers, but also savings. That's money that we put, excess income that we put aside with banks, the taxes that we must pay to the government, and finally, those import expenditures, those goods that we buy from overseas, which leaves our economy, leaves our flow. And as it suggests there, they are a leakage, and they have to be, again, balanced with an injection. Because if they're not, the flow of the water that sloshes around our economy will run dry. And therefore, as a result, the economy will break down and won't function. But that doesn't happen. So there must be something to balance that leakage too. And you can see that in the next slide, we simply reflect the fact that although we buy a lot of goods from overseas, we also export goods and services, particularly, you could argue, to other economies, to foreign overseas economies. So, for example, the financial sector of the UK is one of our export successes. I think it's actually possible to overdo it, but it is certainly one of the significant contributors to our export revenues from around the world. So money comes into the economy, into our domestic producers, from their sale of goods and services to foreign consumers overseas. And of course, that brings money from their circular flows into our flows. It's an injection into our system, and therefore something that balances out, to a degree, the imports that we purchase from overseas. Okay, so that's the model as we've now constructed it. We started off with two sectors, consumers and producers. We added financial sectors, government sectors, and finally a trade or international trade sector. So this is how our algebra now looks. Why? Income is made up of consumption, savings, taxes, and import expenditures. Or, to put it another way, because we are assuming that each of those leakages is balanced out by an injection. So income is equal to consumption plus investment plus government expenditure plus export revenues, export monies from overseas. Now that starts to look a much better model. That starts to look like something that we can really build and develop and use for our economics. The next point is therefore pretty significant. It's this idea of what we term equilibrium. Now, equilibrium is a really important word in economics. It means, as this presentation suggests, balance. It means that our system is sustainable in this case. So, assuming that we are in a situation of equilibrium, that means balance. That means that the leakages that leave our economy must be compensated exactly by injections. Another way to look at that is leakages equal injections, or if you like, savings plus taxes plus imports are equal to investment plus government expenditure plus exports. And therefore, as a result, we have this situation of sustainability in our model, an equilibrium. Now, that's a word that you'll see and come across and use an awful lot in economics. And it's an important one for our assumptions about how we understand and use economics in our analysis. Now, this slide, which is a little bit more sophisticated, you can tell I've pinched this. This slide is about changes in those injections and withdrawals. Now, I started the last slide by saying that, if we assume that the system is in balances in equilibrium, injections equal leakages. In this case, we're talking about another expression for leakages being withdrawals. So we initially assumed that injections equal leakages or equal withdrawals. What happens if that isn't the case? And hopefully you can see that actually there's no necessary reason why it would be. This little pictogram simply suggests that, therefore, if the injections equal withdrawals, then we have balance. But if, for example, investment, government expenditure, and exports, our injections are greater, bigger than our leakages of savings, imports, and taxes, then the level of national income will go up. The money that circulates around our model will rise. If the converse is true, if, as it says at the bottom, the injections are less than the leakages, in other words, the leakages are greater than the injections, then the level of national income will contract and the system will start to get smaller, to run more and more dry. And you can see, I hope, therefore, from an economic point of view, from an economist's point of view, you probably want your injections to be greater than your leakages. But that's a difficult aspect because, of course, if you think about that, that probably suggests that we're exporting more than we're importing. And that means, of course, that some other economy has to be importing more than they're exporting. So it's not an easy circle to square. And that's the sort of things that we'll talk about quite a lot in the pursuit of economics, macroeconomics particularly, over the next couple of years. Now, what can we draw? What conclusions can we draw? Well, based on our little circular flow model, based on our approach in terms of understanding how an economy functions, which hopefully all of that sort of sectoral approach has given you an understanding of how money moves around an economy, but also how it leaks out and how it's injected back in. Well, given that we've put that model in place, hopefully you can see that the income for individual households is the income for everybody, since virtually, and we can talk about definition here, virtually everybody is a member of a household in some respect or another, and probably by definition are. If that's the case, the income for all households is the total income of the economy. So why that income that we talked about in our notation, in our algebra, is in fact our national income, the total wealth of the economy. So therefore, GDP is what we're discussing. We're talking about gross domestic product. And therefore, based on what we've already constructed, it is equal to Y, GDP, national income, if you like, being equal to consumption expenditures plus savings, plus taxes, plus import expenditures. Or, with a bit of substitution, and hopefully you might be able to see that this makes more sense, income, GDP, is equal to consumption expenditures plus investment in the economy, plus government spending in the economy, plus the export revenue of the economy. That's where wealth comes from. So all I've done is effectively substitute the leakages there for the injections. So effectively, S plus T plus M has been substituted for I plus G plus X. I've just swapped those two terms over because we're assuming that the economy is in equilibrium and leakages are the same as injections. So we can just swap those terms out to give us this term at the bottom, which is really quite useful and is something that we'll build on a lot throughout the length of the course. Now, okay, let's think about that for a moment. Why is that so important? Well, we're just going through an unprecedented time for the economy, and a very unprecedented and a difficult time in some respects, I'm sure, for all of you. Now, given that, we can think about exactly what impact this is going to have on the economy moving forward. Now, we all can, I'm sure, suspect and surmise again that that's going to be a negative impact. But economics in this simple form gives us a more mechanistic, more theoretical structure on which to build that analysis. If we're saying that income is equal to consumption plus investment plus government spending plus exports, then we can pretty quickly work out that things like coronavirus, things like Brexit, which is now much, much less significant in terms of impact, will have a very meaningful effect on the GDP, which is the wealth of the economy, as I've suggested. If we are furloughed, as many, many workers are, in receipt of 80% of their salaries at the moment, and the government has spent an awful lot of money to try and prop that part of the economy up, quite rightly too. As that tap is turned off in October, as it must be, and phased from July, I believe, if that tap is turned off, then people will have less money to spend. It's inevitable that some jobs will be lost. Therefore, the consumption, the amount of money that we spend on domestic goods and services in the economy must fall. Equally, we won't have as much excess income potentially. We won't have as much money to put aside. And that means that the savings in the economy must fall. Now, as we've already discussed, already shown, that investment comes from savings. So therefore, as a result, you can see that if savings falls, then so much must investment expenditures. So that's another component of GDP, which may well fall as a result of coronavirus. Government expenditure, well, that comes from taxation. If people are not earning as much money, if jobs are lost, then very straightforwardly, they will not be able to receive as much tax revenue, which means that their government expenditure must fall as a result. And if that's the case, then that will have a negative impact on national income. GDP will fall. And the last impact, or the last aspect, is exports. Again, if coronavirus which it almost certainly does, affects all economies within Europe, within the world, within the international global system, then if incomes rather fall as a result of coronavirus, the ability for economies to purchase our goods and services, our exports, will also be reduced. And therefore, as a result, our export revenues will fall, which will have, once again, a similar impact on our total income, our total output within the economy. So you can see that as a result, just as using the analysis that we've derived from a circular flow model, we can immediately start to rationalize, to explain why coronavirus will end up impacting the wealth, the gross domestic product, the national income of the whole economy, and start to gain an understanding as to exactly how significant, because it affects so many of those variables, than coronavirus is, and what an effect it will have across the board. Now, to finish off, really, hopefully over the course of the last 45, 50 minutes, whatever it's been, and discussing the circular flow model, you've appreciated or started to gain an understanding of how an economy works, how an economy functions, and being able to appreciate how we construct, how we work out what the wealth or GDP of an economy is. Now, to give that some context, the UK is the fifth or sixth, depends how you measure it really, biggest economy globally in terms of GDP, in terms of overall total wealth, by some measures. So you can see that we are significant. We are a big player on the economic scene, but our wealth is dependent upon the same fundamentals as any economy. The level of consumption, investment, government expenditure, and how competitive we are internationally, which gives us a real understanding, I hope, of why economies like China, like America, like Germany, like Japan are as successful and as wealthy as they are. But more of that as we go through the course. And hopefully I've given you a flavour of appreciating what economics is actually all about, what it actually means in terms of a discipline. Now, I would first of all, I'll finish really with where I could just as well and normally do begin. And that's to sort of say, if you go ahead, if you come to economics at Cooper's, I've got to congratulate you. You've made a good decision. You've made a wise decision. And I'm not talking about in terms of Cooper's as an institution. I'm talking about investing in your futures moving forwards. Economics is, without doubt, one of the gold standard A levels. One of the A levels that businesses, universities, employers in general tend to look for in terms of the offer, the sort of candidate that they look for. Economics gives you an understanding of how the world works. Economics gives you an appreciation of what really matters. Economics drives everything. Without economics, you can't have. Without a successful economy, a thriving private sector, you can't have a large, resilient public sector. You can't have the National Health Service without monies being generated from the private sector. So economics, I would suggest, but I would say that, wouldn't I, is what drives all the material circumstances of our lives. So it's not just a question of the fact that you've made a wise investment in terms of your employability, your income in the long term, which you have. There are various studies. The IFS did one recently, which suggests that economics is the best remunerated, best paid university degree you can pursue in terms of graduation, in terms of your long-term prospects. So you've made a good decision economically from your perspective, but I hope you'll come to the feeling that, or to the belief, you've also made a good investment, a good decision in economics, in the subject, because it will give you that understanding, that ability to analyze, to see things, to appreciate things with a perspective that people who don't study economics can't have. And that makes us all feel incredibly superior, which is all well and good. I hope you've enjoyed this presentation, this induction task lesson, if you like. It would have been, I'm sure, much more beneficial for us all to have been able to do this in person. But of course, that's beyond our control at the moment. And all I can wish you is every success in your exams, in the results that are coming your way, hopefully. I hope those go as well for you as they possibly can, and that you enjoy the summer and can look forward to your studies at Cooper's when we return in September, which I hope and trust that we all will. All the very best. Have a very good summer. It's been a pleasure to spend a little bit of time with you remotely, as it has been. Take good care. Thank you.